I've got a question. Would you rather earn 8% in income every single year from a stock that never grows, or just 2% now from a payout that is going to continuously grow and potentially double over the course of the next few years? This is where I feel, and myself included in the past, got dividend investing very, very wrong. And in this video, we're going to go through the maths, the truth, the obvious in the room in terms of why dividend yield is a bit of a problem and why people focus on the wrong thing. And we are going to get a little bit technical, a bit of technical analysis in terms of price performance on some assets as well. So yeah, sit back, strap in, and it could be quite an interesting one. And drop a comment below. What do you think? Do you prefer a high dividend yield? Do you high growth stocks, or the reliable, steady compounders? So just a little bit of a background, essentially. When I first did dividend investing a couple of years ago, I was looking a bit too crazy at certain numbers and trying to boost the income, but overall price performance wasn't really living up to it. Now, investor A may well be looking for a 7 to 8% dividend yield, which, fair enough, you might want to, but I don't see why. After watching this video, you may change your argument. But that stock in value appreciation, the price of the asset may well go down or not grow much at all over the course of time. And then you've got investor B, who's looking at a 2.53% yield on a stock that grows its dividends between 5 and 8% per year and appreciates in value because that overall company is growing its dividend. And that, in terms of mindset and psychology of a growing company that's got a lot of money that is growing their dividends and rewarding shareholders over the course of time, is a massive, massive psychological perk of buying something that is safe and potentially reliable that, let's be honest, people want to hold. And there's also this little weird theory that with that high dividend yield, sometimes when dividends are about to get paid out, people dump it. And you can argue that on a lot of stocks, when there is dividend payouts, the price does drop. Now, what we're going to look at on the screen here, I know it's a bit wishy-washy, and you may be like, oh my God, what on earth is all this? This is technical analysis. Hello, welcome to it. This is Vodafone. Its yield is approximately 8 to 9%, and it's down over 50% over the last 10 years. Dividend cuts, weak growth, and shrinking telecom margins have created a bit of an issue, but guess what? You still get your yield. Yeah, that's a really bad example, I know. But as you can see, over the course of time, it has dropped significantly in value. If you were holding from 2018, 2019, ouch. Now, Imperial Brands in the short term is doing relatively well, but again, over the course of time and the whole element, right, bear with me, of dividend investing is about time. Now, yes, you could argue certain situations here, but let's be honest, that is a hell of a drop. And the reason being, it's tobacco industry. That's a bit of a grey area. But they do have high yields, obviously. Then you got something like Lego in general that does absolutely nout, literally, decent yield. So it's maybe an option, but ultimately there's not much growth at all here. And then you got something like Phoenix, which 10% yield, but ultimately has been down more than up and has hit some crazy, crazy, weird sort of vibes, realistically, let's be honest here. But these weirdly do kind of attract certain types of investors. They're called dividend traps, where high yield compensates for weak business prospects or declining capital. And you could argue with a couple of those, with certainly Vodafone. You could probably argue Imperial Brands as well. There's a little bit of an element of competition there and also change in regulation. Now, if we look at the other side of the market, a strong growth defense sector tailwind here is BAE Systems, which offers a 7.8 or 7 or 8% growth CAGR over the last 5 years, essentially, and a 3% dividend yield. But even over the course of time, it's actually been doing pretty damn well. Unilever's another one, 3.5% yield, roughly a decent growing yield. Global consumer brands, it's doing really well, and it's kind of all there to see. Now, Coca-Cola has been an interesting one. Now, this is very cyclical, obviously, with potential elements around COVID and stuff like that, but it's the bottling company for Coca-Cola. Again, 2.8% rough kind of yield and a very, very good growth, 9% CAGR. It's doing pretty well, and realistically, as you can see here, even in the course of time, it's done well for a while and has actually grew more than actually went down, which is quite good. And if we're looking at the American growth stock of 0.8% yield with a 10% growing dividend yield, it is low yield, but it is a rapid appreciation in terms of the dividend itself. It's growing pretty aggressively. Now, the big difference between all of these, and it's kind of obvious, and I mentioned it before in my previous video, so please do like and subscribe if you want more. The compounding dividend growth element is the hidden thing under the hood. On the screen, you can see the chart. It's pretty clear. Yield on cost. And what this is basically demonstrating is how that yield over time will grow as the dividend grows. And you can see over the course of years, it will gradually get bigger, 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 especially if you're buying strong compounding dividend stocks that you can hold and not worry about. And they are gradually going up over time. Yes, there's going to be periods where they go down, but more importantly, they don't just go down forever, which is quite important. So when you talk about that, you can see key metrics here, which is going to be very, very important. So if you're putting 10 grand in 20 years down the line, it's going to be worth a lot more in value because you are getting more for those stocks that you bought back in the day. But the caveat to everything, and it's obvious, dividend growth often signals a strong business fundamental balance sheet growth process the lot. It's higher chance of wealth building, in my opinion, lower drawdowns, and more importantly, better compounding. If those payouts are getting better, it's because they're doing the right thing. They're making more money and it's going to you. And even in the short term, if we talk about compounding and when high yields could work, it could be for certain environments, right? Realistically. But on the screen, you can see how, yes, high yield as total income. Now, this is just the income received will be better, but it will be your portfolio value that will give it the kind of the edge here. Even though 20 years down the line, you may be looking at it going over crossover here, but if you're a retiree or if you're an income seeker right now, yeah, you may well be looking for the payout, let's be honest. Or if you're looking at certain utilities or high yield dividend funds, like, the UK high yield dividend fund, but it doesn't perform as well as the others, for example. But as I say, you could be looking at interesting propositions where your dividend rate is cut massively overnight because they cannot afford to do it and they've got to pull back. Again, we go back to that point of a strong fundamental company. Why be with something that's 10% yield and then all of a sudden overnight it halves and then that creates a whole stock market price of that asset to drop? So yeah, they can be, in my opinion, a red flag and a bit of a trap. But there is certain niches around the market where you can allow this to happen, but in moderation. But on the screen, what this shows is a 2% capital growth can perform a little bit better, but it nowhere near beats the dividend growth. Obviously, yes, you can have eroded capital with minus growth and stuff like that, and obviously cut dividends and stuff like that. But trying out with a high yield in your performance over the last 10 years is down 60, 70%. What is the point? I mean, your income's there, but bloody hell. I mean, are you going to live off the income and watch it all erode? What's the point? You might as well not bother. So you're probably wondering, why do I bother with reinvesting my dividends and using only growth kind of ones within my ISA? And the key word is, yes, it's an ISA, yes, it's tax efficient, and I want to build it over the course of time, and I want it to be a bit of a challenge as well to hit some lofty targets so I am set up for the future. You can see on the screen here my overall performance in my portfolio. There's a link below to this if you're interested. It's a really good tool and I highly suggest it. The yields aren't amazing, but they are not all low. They are not all high. There's a bit of a difference, but all the dividend growth yields are relatively good over a 5-year period, which is quite hard to kind of do with when you consider what happened with COVID and stuff, and it kind of ruined it. These are all tax-free income. It's a long-term ISA snowball effect, and the yield on cost becomes a very, very huge metric when starting young. I still look at myself as relatively a young investor. I've got a decent chunk in my portfolio. I want to add even more. And over the next 10 years, it will start to kind of showcase, wow, this could really compound into something mental. But I still have to keep an eye on it. I still have to look at this because stuff like BAE Systems, Coca-Cola, even Shell with a decent growth target, there still could be issues that could happen. But ultimately, I've got to keep an eye on it, which is why it's important. In the long run, it's not about the yield today. It's about buying really solid companies that you think are going to be around for the next 10 to 20 years that are going to continuously grow their dividend and pay out to shareholders like yourself. But yes, I know there's a lot to unpick, and a lot of people have different variants to all of this. And I understand everyone has a different relationship with money, and people want to invest for different reasons as well. But as I say, in the long run, it's not about the yield today. It's about owning something that you believe in as a company that will grow, will survive, and will pay you more and more over time and compound inside your ISA, whether it's tax free or into your general investing account or even into certain pension funds where you're looking at certain things. Warren Buffett got incredibly rich over time by investing in solid, growing companies that it does work. And Not everyone agrees with it, and I think a lot of people like the quicker route. But for me, right now, what's the difference between separating your account up a little bit and going, well, I quite like having a bit of income and using that, or getting paid every single month in certain dividend stocks or whatever it may be. But there is more risk attached to that in terms of value appreciation. I think you're better off having both. Value appreciation trickling up alongside the dividend yield, alongside that yield on cost over time equals money. And if you want to see what I actually hold, and I know I've showed it on the screen, but if you want a breakdown of every single company, watch this video.